The Fiscal Fortress, where wealth meets wisdom.
Happy Friday, Michelle. It's so great to see you.
It's wonderful to see you too. How are you, Eric?
Yeah, doing well. Doing very well. It's a crazy week in the markets, and I was really looking forward to chatting with you today about the topic. It's the last few days have been action packed.
For sure. It's even just, I'm not in the finance world, but I just, having seen the markets, I think it's definitely on people's minds, especially since we live in Silicon Valley and a lot of the tech stocks are taking a hit in addition to other industries.
Yeah, exactly. We're obviously recording this on a Friday, and we typically takes us a few days to upload the videos. So when people listen to this, just know that we're talking about things that essentially took place the previous week. And before we get into the topic, I wanted to just reiterate an offer that I'd made previously, which still stands to any of the viewers and listeners of this podcast. If you are interested in investing generally, or you're interested in actually the topic that we're going to talk about today, which is how to protect yourself against market declines and what people who are selling or thinking in the market, I wrote a book called The Long and the Short of It, which I'm happy to send to people. And feel free just to email me, and I'll with your email, your mailing address rather, and I'll get that out to you. My email address is eric@lighthavencapital.com, and we will also include that in the show notes so that you have it.
Mm-hmm. And are you going to charge for sending the book out?
No, for the listeners of this podcast, no. We're just going to send it out complimentary as a thank you for supporting the channel.
Mm-hmm. That sounds like it sounds like a great offer, an incredible offer, and I've read the book, and it's certainly it's a wonderful in-depth discussion about not just investing in the long part of the market, but also knowing what happens in downturns, and that's the topic of today, isn't it?
Yeah, it is. As we both alluded to. It's safe to say that there's some people who are panicking, and chaos is probably an appropriate word for some industries right now.
Yes. Do you find that during the times of chaos, do you do anything, or do you just try to not do what everybody does?
That's a great question. I think obviously I'm a hedge fund manager, so I'm constantly watching what's happening in the markets. And I will say that generally speaking, I try to do nothing. I'm a huge fan of Warren Buffett and Charlie Munger, who passed away. And these legendary investors have a lot of experience and have the view that generally speaking, timing the market is a really difficult thing to do. And for the vast majority of people, unprofitable. And so they've always advised basically keep a long-term perspective, stay calm, use market declines like this as buying opportunities instead of panicking and getting out of the market. And I certainly agree with that. And I think that the modern market is complicated. There are things that are happening that weren't true 40 years ago or 30 years ago. And a real example of that is just the level of, government intervention. We'll talk about Trump more specifically, like what's happening now, the changing of the trading relationships amongst countries like this. These are really big changes. And then of course AI and things like that. So there weren't that many situations in the past where you had situations like COVID or Trump comes along. And I think it's totally reasonable for people to diversify. Like on the one hand to, have a bucket where it's like, I'm just going to close my eyes and go long term and just not worry about risk or the downside. And at the same time, have some portion or have some thought to, or recognition that there have been situations as recently as like the global financial crisis or the dot-com boom, and going back like the oil crisis and the Great Depression, where there are literally like 5-10 year periods where the market's done really, really poorly. So, if you're thinking of retiring in the next 5, 10, 15, 20 years, like this is pretty important. Like the movement of the market directly impacts you.
For sure. I think a lot of people are divided in terms of whether or not they're going to take action in this time where there seems to be an opportunity, or the ones who are cautious and thinking that it's just too volatile to go in. But what's Buffett's take in this time?
Right. So, Warren Buffett, again, I'm repeating myself a little bit, but like he's always been of the mind, don't panic, stay calm, carry on, buy the dips and things like that. And I think that it's important to note that, Berkshire Hathaway is, one of the core businesses that Berkshire Hathaway was built on was insurance, or one of the key industries. And so they've always had like essentially a steady stream of income and an ability to weather the storms that, other people may or may not have had. The other really interesting thing is there's been a lot of news about this, but Buffett, has a record amount of cash on the balance sheet. Now he's not panicking. He's not, certainly selling everything, but there's a very famous indicator that Buffett has talked about, and he essentially looks at the total market capitalization of the stock market, and I think he uses the Wilshire 5000. It's basically the 5,000 largest, public companies in the United States. So the market cap of those 5,000 companies, that's the numerator, divided by the GDP of the country, and that number essentially in plain English is like how much are all the companies worth according to the stock market divided by how productive the country is, right? And that number is, people call it the Buffett indicator, is at an all-time high. And that means that, this kind of explains why Berkshire Hathaway and Buffett have so much cash. He's essentially worried, and this is my interpretation, that stocks are overvalued. And I follow a slightly different indicator, which is essentially the price to earnings ratio. And so these are flashing kind of danger signals that maybe we're due for a crash. And maybe that's what we're seeing now, the start of that, or maybe we're in the middle of it right now. How about you personally? I know, like most people in the Bay Area and Silicon Valley, we have a lot of our wealth in stocks. A lot of people in the Bay Area, they work for public companies, especially in the technology industry. Just on a personal level, Michelle, are you worried about what's happening in the markets?
Well, I always feel like I should have invested more during that whole rise since the financial crisis. So we're not fully invested. We certainly could use an opportunity, like if if there was a huge dip, then we would go in. So that's where we are, is that we're not already saturated with tech stocks. So I am looking for a chance to go in.
Right. Well, that's a good position to be in. And, the topic of today is really kind of what's happening right now, which is, the market's on a decline, or it's correcting. But, it's just a matter of time. I think that the market will also change course, and it'll be a good time to buy. And that'll be the topic for another episode for sure. So,
Eric, in terms of all this volatile activity going on, what does our listener, what should the listener think about in terms of which industries you think will be impacted, what companies specifically, and what they can do if they want to take action during this period?
Yeah, great question, Michelle. And I guess I'll start with kind of what to do generally first, and then we can talk about industries and specific companies and do it in that order. Um, as I've kind of alluded to, like it's totally reasonable, I think, if one option is you basically just ignore what's happening right now and think long term. Now, to be clear, long term has to be like 5, 10 plus years, right? Like it can't be ignored for a year because that's really not long term. And that would be consistent with what I think a lot of what Buffett would say. And you just have to be okay with the volatility, and there will be massive volatility. It's in the global financial crisis, the market corrected more than 50%. So that's one option. I do think that realistically, some people just aren't going to be comfortable with that because maybe they have a lot of money in stocks. They're not, super diversified, or they're about to retire in 5 or 10 or 15 years. And so that's not a super attractive option. So if that's not a good option, then I think another possibility is you could try to diversify. You could try to raise more cash, sell some of your stocks, not all of them. You could potentially move money into, and this is controversial, but Bitcoin or other types of asset classes. The challenge with that is that increasingly, and this is a modern phenomena, that a lot of these asset classes are increasingly moving together. They're more correlated. It used to be that stocks and bonds didn't move together. And there's thought that crypto would be a hedge, but increasingly a lot of things are kind of moving in tandem. I would point out that recently some investors and people have started to buy a lot of gold. And so that's just something to look into. I'm not an expert in gold, but it does seem to be a safe haven, gold. So that's another thing that you could do. So diversify. And then a third thing you could do is you could actually hedge. And that's obviously, I run a hedge fund. That's what I do. That's the option I prefer. There are some problems with this. Basically, it's hard to do. It's technical. There is risk. It requires knowledge. You could essentially work with a hedge fund like Lighthaven, so outsource that, or other people, could learn to use options, like you could buy puts or short the market. But again, kind of technical, and probably not for everybody.
I think the hard part is that investments are always, it's hard to separate the emotion from it. So for those in the audience that see a 10% drop in their portfolio, it is very tempting to just err on the side of caution and just cut their loss, as opposed to just waiting it out and just seeing it come back.
It's true, and sometimes it won't always come back, right? I mean, there's a lot of judgment involved in these decisions, and you have to be right. I mean, you're going to make or lose money based on whether your bet or your decision is correct, and that is really anxiety and emotion inducing. This is probably one of the reasons. I think it's a strong argument, one of the strongest arguments that a lot of people make, that you shouldn't basically do this yourself. You should either outsource it, or basically, as I said, like a legitimate option is just close your eyes and just think 5, 10, 20 years out and not worry about the short-term volatility. That's I think that's a totally reasonable approach. And on the other hand, like to the extent that you get educated, to the extent that you are thoughtful about this, I do also think that you can do better than that by diversifying. I mean, even, turning it back to Buffett, even Buffett, like he would be the first to say, like, don't market time. And at the same time, everybody sees that, he is raising cash right now. And he is the guy who's buying when the stocks are cheap. Like, and that's not market timing. That's just being smart. And I think that he's not just like closing his eyes and doing nothing. Like, just to be really clear, right? He's actively making smart decisions, but the quality of those decisions and how you do them, that matters. And I think that's what we're talking about here.
Mm-hmm. I think this was very helpful to hear because I got a couple takeaways from it. One is that if a listener has experienced losses, that they should think longer term, 5 to 10 years. And if they haven't acted or gotten into the market yet, now is a good time to build that shopping list.
I agree
and
with
to be
both
careful.
responses. Yeah.
Yeah,
And to be
and
careful
to be
and thoughtful. Careful and thoughtful. Like this is, we're talking about obviously your life savings, a lot of money. Like if you're going to spend a lot of time thinking about something, this would be it. Like your stock decisions, right? And whether you buy and sell, you should probably, Peter Lynch, another one of the guys that are legendary investors, I really love it. He says like you should spend as much time, researching your stocks and making decisions as you would like if you were buying a new car or refrigerator. People spend so much time on their purchases and they spend so little time making stock decisions and doing analysis, and that's just backwards. So people should remember that.
Yeah, so this does sound like we're at a moment where it's a very important point where it's been 15 years plus since the last major correction, and we could be at the cusp of one.
We'll see. Certainly don't want to create anxiety for people. It's not time to panic, but it is time to watch and to think. So I completely agree with that. And we'll keep people posted on this podcast, on these videos. This is something that we're watching closely, and we'll continue to educate people and give you our unvarnished thoughts.
Thank you, Eric.
Anytime. Thanks. It's great seeing you, Michelle. Until next time.
Great seeing you.
Take care.
Yep. Okay, and one last thought is if the next episode is going to be on legal. So if anyone from our audience has a topic they wish for me to cover, please let me know by sending an email or leaving it in the comments.
The Fiscal Fortress, where wealth meets wisdom.